Good afternoon, and thank you for joining us today. My name is Krista Hicks. I'm Senior Vice President of Business Development here at Global X Canada, and today we're looking forward to a discussion on catalysts and crosscurrents, portfolio construction and positioning in 2025. Joining me today are Chris McHaney, CFA, Executive Vice President, and Head of Investment Management and Strategy at Global X Canada, and Candice Bangsund, CFA, Vice President, and Portfolio Manager, Fiera Capital. In today's conversation, Chris and Candice will discuss themes and trends to watch for in 2025 as investors look to allocate capital in dynamic global markets. We can expect to hear their views on everything from tariffs, inflation pressures, and geopolitical conflicts, and most importantly, how it can affect Canadian, US, and international markets and investment outcomes. Candice and Chris will also discuss portfolio positioning and adjustments given the current market environment and what investors should think about when allocating to Canadian, US, and international equity, fixed income, gold, and other asset classes. With that, let's open up the dialogue. Candice, we'll start with you. Can you talk about Fiera Capital's macro outlook and base case market scenario for the next 12 to 18 months?
Absolutely. Thanks, Krista. For those of you who follow the research we do here at Fiera Capital, you'll know that we use scenarios and probabilities in driving the asset allocation decision. This really just hinges on the fact that we're not 100% certain about anything, especially these days. And it's really an act of risk management, acknowledging what your high probability scenario is and the risks to that base case. And right now, and for the last 12 to 18 months, the scenarios have largely been driven by, what's the path to 2% inflation or back to 2% inflation? How are central banks going to get there? And what are the implications for the economy? We've heard a lot about, hard landing, soft landing, no landing, and obviously this has very important implications for financial markets. The first mile of getting inflation back from, say 9% back to 3% was pretty smooth. And obviously investors have been bracing for that soft landing scenario where central banks miraculously get inflation back to 2% with very little damage to the economy or any material increase in unemployment. But I would argue that, after largely pricing that in for much of 2024, the risks now are skewed to something a little bit more in the inflation revival camp. The latest, I would say, macroeconomic and political developments, of course, have tipped the scales towards that scenario where central banks may need to keep interest rates higher for longer, given a backdrop of elevated inflation that's proving quite difficult to bring back to 2%. And that's largely the inflation revival scenario because, of course, we're all hoping for the soft landing. This is a great scenario for stocks and bonds for that matter. But it's really a delicate balancing act for central banks because you cut rates too quickly, you risk that inflation revival scenario and a second wave of inflation, or you don't cut rates soon enough and you risk sparking a recession. So like I said, it's a delicate balancing act, but the recent developments, I would say over the last, 3 to 4 months, and particularly coming out of the US election, are that our high probability scenario now is one of an inflation revival, higher inflation for longer, meaning accordingly that interest rates need to stay higher for longer. So when it comes to the assessment of the economy, I'm going to start with the US. This is largely, obviously a major driver of financial market activity, the Federal Reserve, et cetera. So what I'm showing you here are the key policy variables that we are tracking for the US economy. And these ultimately dictate how monetary policy will evolve. And of course, as you can see in the table, the options are basically, can the Federal Reserve continue to lower interest rates, or do they need to keep them higher than expected? And as I mentioned, the recent developments that we've seen, I'll start on the economic front. And as you'll see here, the economy is operating above its trend level. or its potential. So this is inherently inflationary. And lowering interest rates into an environment where the economy is running hot obviously risks an overheated scenario for the economy and, of course, for inflation. The job market remains extremely strong, averaging around 240,000 jobs per month on average over the last 3 months. Rock bottom unemployment. This is not consistent with a slowing economy. And of course, this is keeping wages elevated as well. At the same time, the disinflationary trend that we were seeing last year has stalled out. And, we saw that last week in the CPI numbers out of the US, a pretty hot reading. And of course, this comes at a time when, like I said, the economy continues to be strong and wages are elevated. I think the most worrisome development now on the economic front and the inflation front are long-term inflation expectations that have de-anchored upwards. The Federal Reserve and central banks in general spend a lot of time, watching long-term inflation expectations to make sure they remain anchored between 2.5% to 3%. But given, some of the worries on the consumer front when it comes to inflation, whether it be through tariffs or even, the environment that we're seeing right now of sticky above target inflation, this is a worrisome development. The fact that this picked up to 3.3% just this month. And, the Federal Reserve has clearly taken note the last 2 weeks specifically, the rhetoric, whether it's from Chair Powell, the governors, regional Fed presidents, is all one advocating for a patient approach going forward. And all of which is suggesting, that the Fed may need to remain sidelined for longer than the market is currently or is expecting. And then amplifying this or accentuating those upside risks to inflation are, of course, political developments. And coming out of the election in November, the Republican sweep scenario, the inflationist and pro-growth policy agenda stemming from the Trump administration, which now we're starting to hear more about early on this year. This is adding to those upside risks to inflation, whether it's tariffs, restrictions on immigration. This could create shortages in the labor market that could put upward pressure on wages that are already elevated, fiscal spending, all of this adding to the upside risks to inflation and really tilting the scale from a soft landing towards an inflation revival scenario. And obviously, this is something that the market is not pricing and suggests that interest rates need to stay higher and potentially even move higher at the long end. Now, when I think about Canada, the Canadian economy tells a different story. Our economy, of course, has been much more sensitive to, previous tightening, given elevated household debts, the structure of our mortgage market being shorter term in nature versus the US. So we have actually seen the economic pain associated with interest rates going from 0 to 500. That, of course, allowed the Bank of Canada to lead the easing cycle last June and has been the most aggressive, lowering rates by 200 basis points now to 3%. But, this outlook for the Fed has also really limited the maneuver room for the Bank of Canada from here, in our view. Because, of course, with inflation now front and center, with the potential for tariffs and retaliatory action, the last thing the Bank of Canada will want is a much lower currency, a Canadian dollar, because that, of course, is inflationary in nature as well. So it puts the Bank of Canada in a pretty difficult and challenging position where they need to balance a slowing economy against upward inflationary pressures. But even then, some of the recent data that we've seen out of Canada has been stronger. It looks like the economy's improving. The job market has been pretty strong for 3 months in a row. In the fourth quarter, it's tracking around 2%. This is above the Canadian potential rate. Even inflation has picked up here. We saw the CPI numbers this morning. And somewhat worrisome is that, the core numbers did re-accelerate up to, high twos and on an annualized 3-month basis around 3%. So in our view, this really has limited, where the Bank of Canada can go from here at a time when they need to protect the economy given risks on the trade front. So the inflation revival scenario is really one of uncertainty when it comes to the outlook for monetary policy, but of course then lingering geopolitical and political headwinds, with the potential to create more volatility in 2025 than we were accustomed to in the last 12 to 18 months.
Thanks, Candice. Chris, perhaps you can touch on your views and whether they align with or differ from Candice's.
Yeah, thanks, Krista. And I would say largely we do align with the scenarios that Candice outlined. And thanks, Candice, for giving the inflation revival as your base case. I think almost everyone out there has soft landing as base case, which is what we want, as you said, but I'm not sure that's necessarily going to be the base case. And really, it is that story between the differential between the Canadian economy and the U.S. economy right now. And as Candice mentioned, the difficult position that puts the Bank of Canada in. Typically we see short-term interest rates in Canada and U.S. move very much in tandem, as you can see from this chart here. Never really differing by too much. And what we're at now is about a 1.5% interest rate differential just between those two overnight rates between the two countries, and actually forecast to potentially even get a little bit bigger. As you can see, those dotted lines giving you sort of market pricing as of now. So this is really a differential that you'd have to go back to the early 90s in order to find another time when rates were this far apart. And what that's really doing is putting a lot of pressure on the currency. If you take a look at where the exchange rate is right now, we're kind of on the upper end of where we have been over the last, call it 10 plus years. We've really seen Canada USD trade in this range for 10 plus years now, and we're really knocking on the top end of that. And really by showing just the history of that FX rate you can see that even though the past 10 years have been in a range, we really could go much higher or much lower. So we do see potentially continued pressure on the Canadian dollar, and it will depend on that future path of interest rates to some degree. Does Canada keep cutting? Does the U.S. cut at all? Or do they stay the course, so to speak? If we do look at U.S. interest rates and expectations for that, going back to September, not even 6 months ago, if you look at that light blue dotted line, that's what the market was pricing in for U.S. overnight interest rates as of in September. So again, not more than 6 months ago, 5 months ago, market was expecting kind of 3.25 on the U.S. Fed funds by mid-year 2025. Obviously, that's not going to happen, and over time, that has really been priced out. And now we're looking at potentially no cuts in the U.S. this year, maybe one or two, as sort of the base level of pricing. But also, interestingly, there's about a 25% probability priced into markets now that the next interest rate move by the U.S. will be a hike rather than a cut. And so increasing momentum towards higher for longer rates, particularly in the U.S. Now, why is this happening? Of course, Candice outlaid that GDP growth, where we've been over the last really couple years, U.S. continuing to be strong, Canada a little bit weaker on the GDP and more interest rate sensitive, feeling the pinch of those higher rates a little bit more than in the U.S. And if we take a look at, again, going back south of the border, inflation expectations ramping up significantly again here in the U.S. Now, these are just a survey of expectations. This is not hard data, but we do know that inflation is a very psychological type measure that can almost be self-fulfilling. If consumers expect prices to be higher a year from now, they'll continue consuming, which actually causes that inflation to happen by keeping that consumer demand high. So something to really keep in mind here is that potential reacceleration of inflation, particularly in the U.S., and that higher for longer scenario. Jerome Powell talked about it a lot in 2022. After rates went up, immediately people started talking about when are rates going to come down, and he kept saying higher for longer. The reason he did that is because he was aware, or the reason he said that is if we take a look back in the past, the 1970s, this is something Powell has been very, very concerned with, is that after that first bout of inflation, if you get that under control, cutting interest rates too soon can actually cause that inflation to come back very quickly. And this is what we saw through late 60s and through the 70s. If you could see that dark blue line representing inflation from 1966 to 1982. And after that first bout was taken care of, interest rates were cut and very quickly inflation came back. That orange line mapping where we are today from 2014, and again, getting over that first bout, but really a lot of signs pointing to inflation re-accelerating. So we don't expect really any interest rate cuts out of the US anytime in the near future. And in fact, when we did see that first 50 basis point cut, you saw long-term rates actually go up significantly, which is pretty rare. Typically, when the U.S. is cutting rates, yields are coming down across the curve in varying degrees, but they generally come off across the curve. What we saw earlier this year was the Fed cut by 50 basis points, and immediately the 10 years and later, yields started going up. And so this is something, this inflation revival is something that the market is very keenly aware of, and I think is going to be watching the Fed for their next moves to see any signs of that inflation coming back.
Thanks, Chris. Interesting to hear both viewpoints. Candice, what are the other scenarios that your team believes could occur going forward?
Yeah, so I mean, the risks to the base case of that inflation revival scenario that we've been talking about are twofold. There's the upside risk, which is obviously the optimistic soft landing scenario that's largely been baked in the cake at this point. So really not a lot of upside for markets in that scenario, because as Chris mentioned, this is largely what the market is bracing for at this point, which this used to be our high probability scenario in 2024 or early 2024. But as you can see now at 20%, it's tough to see given those inflationary dynamics that have now been compounded by an inflationist policy agenda coming out of the United States. On the downside, we've added a new scenario just recently in the fall, one of stagflation, and this is really the main risk out there right now, and it's really stemming from the potential for a full-blown trade war, because in that situation you would have high inflation that's at odds with economic stagnation, and this of course is an extremely dire combination for both stock and bond markets. But back to the inflation revival, in this scenario you have interest rates probably on hold, but again, this hasn't been priced in the market, so you're going to see some upside in bond yields, likely a bear steepening with a bigger move at the long end of the curve. We've got the US 10-year going to 5% in the next 12 months, given these developments and given the higher likelihood that inflation is here to stay, triggering a more hawkish response from the Federal Reserve. In stagflation, we actually have the Fed reverting back to rate hikes. And this is something I believe Chris just mentioned as well. Should long-term inflation expectations unhinge to the upside, and should that become self-fulfilling, we're quite certain that you would see central bankers come back to the table and raise interest rates. And of course, again, that would be a negative outcome for stocks and bonds, albeit at a larger magnitude than the inflation revival scenario. And then, of course, as I mentioned, the soft landing scenario, I mean, the market has been pricing this for the last year or so, bracing for aggressive rate cuts. We did see, 4 rate cuts from the Fed. I would argue that it was a touch hasty for them to start when they did. It was one bad unemployment report, and they were spooks, and they transitioned their focus from the economy and the labor market to inflation, and then back to the labor market and a potential deterioration, and started cutting rates. Would argue that may have been premature. So I won't say that the risks are balanced, because what you're seeing here in our matrix is that 80% of our scenarios are in scenarios that are negative for the stock and the bond market, and really underscores our defensive stance.
Okay, so given the base case you've presented and other risks that you're seeing, can you talk about how you would approach capital allocation to equity markets, fixed income, and other asset classes?
Yeah, so as I mentioned, just in general, we are defensive, and not surprising given those scenarios. It's quite underwhelming right now, given the outlook with equity markets priced where they are, lofty valuations, in an environment of heightened uncertainty, whether it's on the geopolitical front, the macroeconomic front, the outlook for interest rates. All of this, has the potential to inject some more volatility into the equity markets at a time when they're already trading at, in our view, quite lofty valuations. So we're underweight equities overall. Within equities, though, we do have a call on Canada versus global, and specifically versus the U.S. And that's really just a call on valuation and rotation. And especially in an environment where interest rates are higher for longer, when you have elevated inflation, this is typically more positive for value versus growth. And of course, this is notwithstanding that worst case outcome of stagflation and a full-blown trade war. Outside of equities, though, we also maintain our underweight allocation to bonds. And again, that's given our outlook for long-term bond yields to move higher and, a bear steepener sort of move. We are overweight cash, not surprisingly. As we navigate this, the challenging environment. I would highlight that areas of opportunity, and this is more of a strategic allocation, but as a substitute to traditional fixed income and even stocks, private alternatives, really, the environment right now really underscores the case for stability in yield. And you can get that in the private space, whether it's in private credit or real assets, inflation protection, on the non-traditional income front. But even on the equity front, going into something like private equity where you're getting equity-like returns, but at a lower volatility. So from a risk-reward perspective, I think this environment where we expect more volatility, we expect a potential correction, really just underscores the case for non-traditional sources of income and capital appreciation in a properly diversified portfolio.
And Chris, how would your approach differ from what Candice has presented?
Yeah, thanks, Krista. And, really, again, largely similar in terms of outlook there. When I look across regions, though, and we're making allocations for the long term, valuations do play an important role. I would say valuations are terrible at timing tools. Something could stay overvalued or undervalued for a year or two at a time. But when you're allocating for the long term, call that the next 5 to 10 years, when I look on a regional basis or geographic basis, taking a look at where those valuation gaps are, really does speak volumes. The U.S. typically does carry a higher premium or valuation than other regional indices, other global indices, for good reason. But when you see where we are here at the right-hand side of this chart, with U.S. valuations continuing to go up and international continuing to actually decline, we're at a really huge gap here as well on a historical basis. This is about a 3.5 standard deviation event, just in terms of that valuation gap. And so again, when I'm looking at sort of 5-10 years out, I'm gonna maybe tilt a little towards those international areas that don't carry that high premium. When you look at particularly international markets and developed Europe, you're looking at high quality consumer staples, healthcare companies that are global in nature. And so, we do have this prospect of a trade war, and that really muddies the waters for everything international. But just in terms of that long-term allocation, we would think this would be somewhere to look if you are looking at public equities and what regions to look at. If we look across other areas, we mentioned that currency and that continued US dollar strength, at least in the short term, we think it makes sense to maintain exposure there. That does tend to be a risk-off type of a strategy as well. So if markets are stressed, you usually see US dollar strengthen, and that could potentially smooth out any downside risks. And for those that are continuing to look at the US for that growth, again, the economy is still strong there. GDP growth still continuing. And so for those that want to maintain that US exposure, but perhaps maybe away from the mega cap tech, that's really the overvalued piece of the market, maybe look to small caps as an area to invest in that are more domestically focused. Should there be a trade war, and should there be, again, a bit more insular approach to U.S. policy, those small caps should tend to benefit a little bit more from that domestic focus that they have. And then lastly, on the slide there, I should mention lower rates. That should be lower rates in Canada specifically. For Canadian investors wanting that income, we think income will be a continued source of demand. Candice mentioned private and other non-traditional sources of income. We think that makes a lot of sense as well. Of course, we offer a lot of option overlay strategies on top of fixed income. So those non-traditional sources of income, we think, make a lot of sense as well. And on the fixed income side, on the rate side, continuing to stay really on the short end and staying away from the long end of the curve. Maybe for Canadian rates, you can go out a little bit further into the curve, given where the rates are here in Canada, but simply staying a little bit short. The yield is still there, and so we think that makes a lot of sense from a rate positioning perspective.
Okay, we do have some questions from some of our registrants, and it looks like they want to know about sectors that would be sheltered from trade tariffs and the outlook for the energy sector and financial sectors here in Canada.
All right, I'll take a stab at it. Again, like, our base case is not one of a full-blown trade war. So we see more opportunity in some of the laggards should the dust settle, and should that dire outcome not come to fruition. So there's been a lot of talk. You asked about financials, energy. There's been a lot of questions about the outlook for the energy sector. And I kind of have the view that, tariffs on Canadian energy are really a lose-lose proposition for both Canada and the United States, for that matter, obviously for our producers. But in the United States, they need our heavy oil, the refiners, so they're going to be paying up for that. That's going to squeeze margins. That's also going to get passed on to the consumer via higher prices at the pump. So this is actually going against what Donald Trump is trying to accomplish in lowering energy prices. So that could be an area of opportunity should we get a little bit more clarity on the trade front. And of course, that is, of course, the wild card question right now. But you talked about, where to seek shelter. Obviously, gold is probably a good place, as a safe haven. Lots of uncertainty, lots of headlines, noise in the market, tweets, you have it all. And gold could be a good place to sort of hide out. It's also a good inflation hedge, and given both Chris and our outlook for inflation, could be an interesting place to be as well. And you're also seeing central banks diversify away from U.S. Treasuries into gold, which seems to be placing a floor under prices. So those could be a couple of options. Like I said, the first, the energy sector, that's notwithstanding that worst case scenario. And should that actually come to fruition, I think gold could be an interesting place to hide out.
Yeah, and we'd probably echo that as well. Given the assumption that there won't be huge tariffs on Canadian oil or Canadian energy, as maybe cooler heads prevail, at least in that regard, we think that could be an area to invest as well. Here in Canada, I think it comes back to those domestically oriented sectors, and even those, it's tough to say what will not be impacted by tariffs because there's reciprocal tariffs. We might tariff the U.S. as well. And so obviously it's hard to see how all that plays out, but even things like, domestic telecoms, they've been beat up a lot and pay a very nice dividend that generally is focused on Canadian economy only. And so should there be tariffs, one would hope, telecoms and that sort of company and that sort of business is not really affected too much. And you can get a nice dividend while you wait for a rebound there as well. So that's one potential area here in Canada. And the other part, maybe in terms of that energy play, would be looking at uranium. Again, that's a longer-term play as we understand the demands AI and other things are putting on energy demand, with nuclear potentially coming back on as a major source of that energy. as a long-term play, uranium could make some sense as well.
Question number 1, what are the best Canadian and international assets to invest in to offset tariffs or lessen their impact?
Yeah, and maybe I'll just say, I think, again, as hard as it is to decipher what tariffs will be implemented and what reactions from other nations will be, I think it just makes sense to high grade your portfolio overall. Move to those large cap sort of quality stocks that have consistent income streams, and I mean, earnings, in order to be able to ride out any sort of fluctuations and disruptions that tariffs might cause. Really by high grading your portfolio, that doesn't mean there won't be any volatility, but you can, really rest assured that you'll be invested in those areas that can make it out the other side, so to speak, should that trade war start to settle down. So again, it's really about looking at where are those areas that have consistent earnings that can grow over time and relatively low debt as well. And that's going to allow you to ride through any sort of short-term fluctuations or volatility.
Next question. With regards to trade tariffs, which sectors should we avoid and which would be most sheltered?
I think we've talked a lot already about the shelter from the storm. So, avoidance. Well, when you think about tariffs and you think about the impacts, you're thinking about exporters of goods. And in Canada, obviously, the automotive sector is a big player. And even across North America, again, you have to wonder, who's really going to win in that equation, because supply chains are so intertwined, going back and forth, parts and production. This is obviously going to be a big negative for the industry, but also for the consumer as well. But, when I think about sectors to avoid, that would probably be top of mind for me.
And can we discuss how will the refinancing of approximately $10 trillion of national debt that comes due affect American markets and the dollar?
Yeah, I think this is one, obviously, where there could be a supply issue potentially, right, for U.S. Treasuries. Too much supply coming on board, and maybe not as much demand as there used to be. I think, Candice mentioned earlier, central banks starting to diversify away from U.S. Treasuries, adding gold and other things to their central bank reserves. And so there is a possibility of less demand for that asset class, and of course, a lot of supply coming online. What that really results in is long-term rates going up in the long run. And this is obviously the biggest risk that Candice has been flagging. And maybe one thing that can offset that, or potentially is able to offset that, is the current focus in the U.S. administration on spending, and potentially getting government spending, somewhat in line or reduced somewhat from where it is right now at a very elevated level. That could cause long-term rates to settle down a little bit, should we see some material benefits coming out of that initiative that's currently being undertaken. So that's one thing that I think could keep a lid on long-term rates. But, in essence, to answer the question, that's likely the biggest or most possible outcome is long-term rates going up.
Yeah, maybe just to add to that, we've been talking a lot today, tactical 12 to 18 months. This is a longer term, factor that's actually driving our firm view that inflation, not over the next 12 to 18 months, but also over the next 5 years is going to be higher, than we've grown accustomed to over the last several decades, maybe averaging 2.5% to 3% over the next 5 years. That suggests, as Chris mentioned, that interest rates need to be higher as well. So it adds to that narrative where you have higher interest rates for longer, really limiting, the value proposition in traditional fixed income, because of course central banks aren't going to come to the rescue and drop interest rates back to zero when inflation is running at 2.5% to 3%. This is a secular trade in our view, in addition to a number of other factors that are driving that higher for longer inflation view over the longer term, whether it's demographics and aging populations. I've talked about rising debts and deficits, onshoring, that's been a big one, or deglobalization. All of this, again, just, reinforcing the case for non-traditional sources of income in a well-balanced portfolio. And that's why I talked earlier, about asset classes like private debt, real assets such as real estate, infrastructure, natural capital, agriculture. You need that hedge to inflation, but you also need yield, but you also need stability. Because in that environment, markets aren't going to go straight up. There's going to be a little bit more volatility across both stock and bonds.
What is the outlook for the Canadian financial and energy sectors in the coming year? And what effects will the U.S. tariffs have on Canadian oil and gas stocks?
Maybe I'll just touch on financials again. It's really tricky to forecast, again, because the uncertainty around tariffs and how long they might be in place for and to what degree. If I think about Canadian financials, in particular the banks, they tend to be a proxy for economic activity and economic growth in Canada. And so generally, as the economy picks up, banks tend to do well. If we're forecasting an environment where economic growth continues to lag below trend somewhat, I could expect the banks to perform okay, but nothing really outside of that. And so, really what's working in their favor in that regard is, again, a decent dividend yield. Oil and gas as well, generally here in Canada, pays a decent dividend yield. And so for Canadians, wanting to have exposure there, especially if, we're hoping for good news to come through and boost our economy a little bit, it's good to have that nice 4 or 5% dividend yield to sort of get paid while you wait for things to turn around. And really, to me, that's the benefit of the larger Canadian sectors overall, outside of maybe materials. But materials also playing into that real asset sort of, and commodities playing into that sort of real asset type of investment that I think is probably going to work over the next, call it year, 2 years.
And the Canadian banks, too, are starting from a position of strength. And, again, notwithstanding the worst case scenario, should do fairly well in an environment where you still have positive growth, but higher interest rates, higher inflation. Again, this is that rotation that I was talking about before from, say, growth to value. We saw in 2024 a very concentrated equity market rally in the high torque, heavyweight tech space, and a lot of that was driven by interest rates coming down and expectations for rates to come down much further from here. That's obviously positive for longer duration sectors of the market, such as technology. But should we see that scenario where trade tensions maybe simmer a little, we get a little bit more clarity, you can see a rotation into areas like the lagging corners of the market, like financials, resources. But again, that's a big if, and we need to sort of watch the headlines to get a little bit more clarity as to, how to navigate that. Because ultimately, while Canadian banks aren't exporting and really anything to the U.S., they don't have a lot of exposure when it comes to tariffs. The real impact comes from, the economic implications. If Canada goes into a recession at a time when inflation is elevated, this would be, a pretty strong headwind for the sector.
Another one of our registrants is wondering, can you suggest the best ETF in which to invest, where money can grow safely without the chance to lose principal?
I'll go first. Okay.
I'll start. Sure.
I just hope we don't say the same thing.
Well, if I'm thinking about without the risk to lose principal, I'm thinking of short-term T-bills, really. Global X offers a couple of short-term T-bill funds. But I would also mention ticker HFR, which is actually managed by Fiera for us. Very ultra short-term corporate bond ETF. You get Fiera's, company selection in terms of that credit exposure, but almost all the duration risk is hedged out of the portfolio, so the duration's under 1 year. So you're getting a nice credit spread over and above short-term rates, and you're not going to be whipsawed by duration and long rates moving around.
Well, as I expected, you stole my thunder. That was my call. Being from Fiera Capital, I had to pump the tires with my team here. But no, I think HFR is a great call. Like everybody's heard that we have very similar views on interest rates. You want to be short duration. This is cash-like, with a little bit of credit risk, and notwithstanding a recessionary outcome, this is going to be a nice, place to hide out in a period of uncertainty.
And our last question, how do you position your portfolios in regards to digital assets? Do you plan on adding a percentage in something like a Bitcoin ETF or something else?
Yeah, maybe I'll take this one. And I think we both talked about the importance for diversification, non-traditional sources of return. So certainly I would say digital assets fit that bill as obviously non-traditional asset classes or non-traditional investments. The one risk I would say to that is that up to this point, things like Bitcoin and others, if you look at the price action, do tend to perform as risky assets. So, as the equity markets go up, crypto tends to move up with it on a much higher, volatility basis. But same thing on the way down, when markets go down, you tend to see that sell-off in crypto world as well. So, while I do enjoy or appreciate, the non-traditional and alternative source of that type of asset class, I would caution that, up until now, we've really seen it trade very much like a risky asset, like a juiced up stock market, so to speak. So, in theory, it makes sense to put into a portfolio, but I would say this is really still a risky type of asset that might not fit all types of portfolios.
Okay, we are approaching 45 minutes here. We do want to be respectful of everybody's time. I want to thank everybody for joining us today. If you do have additional questions, please feel free to reach out to your respective wholesaling teams across the country, or you can reach out to us at info@globalx.ca, or as you can see, we are available on multiple social media platforms as well. Thank you again, everybody, for joining us, and have a great day.